Guys, listen to this, because it's a story I can't forget. I was absolutely shocked when I saw a family lose over $100,000 during the life of their 30-year mortgage. And it all happened because their credit score was just 20 points too low. That is real, hard-earned money that could have gone to college funds, retirement, better quality of life. This is the kind of devastating financial mistake people do not see coming because the system is designed to be confusing. Today, I am going to explain the simple truth about getting the best mortgage rates. You don't just need a good enough 620 score. To truly get the best mortgage rates in 2026, you need a score near 760 or even higher. We are going to dive deep into what the banks and lenders call loan level price adjustments, or LLPAs. These are the hidden fees that directly impact the interest rate you are offered. More importantly, I will show you one critical mistake I personally made. First, let's pull back the curtain on one of the most important acronyms in the mortgage world, LLPA. This stands for Loan Level Price Adjustment. In the simplest terms, an LLPA is a risk-based fee that lenders add to the cost of your mortgage. Think of it as an insurance premium for the lender. The fee is directly tied to the perceived risk that you might, for whatever reason, fail to repay your loan. Higher perceived risk, higher fee. Higher fee, higher interest rate for you. It's a systematic way for lenders to price risk into every loan. Two primary factors determine the size of your LLPA. Credit score. Down payment, also known as loan to value. A lower credit score signals a history of higher risk to the lender, so they add a pricing adjustment. Similarly, a smaller down payment means you have less skin in the game and the lender has more to lose if you default, so they add another pricing adjustment. These rules are not made up by individual banks on a whim. They are mandated by the government-sponsored enterprises, Fannie Mae, Freddie Mac. They buy most of the conventional mortgages in the United States. Many homebuyers never even hear the term LLPA. They simply receive a rate quote from their lender and assume it is what it is. They might think the bank is just being greedy or that rates are just high that day. In reality, their rate is being precisely calculated based on the LLPA matrix. A lender might say, with your credit score and down payment, the best rate we can offer is 6.5%. What they are really saying is, the base rate is 6.0%, but your LLPA adds a 0.5% adjustment. The bank isn't being mean, it is simply following the established rulebook for pricing conventional loans. It is crucial to understand that these adjustments are tiered. They are not a smooth, gradual increase. Instead, the LLPA matrix has sharp cliffs. The landscape of mortgage lending is not static. It changes based on market data and regulatory updates. A significant shift happened heading into 2026 that directly affects how you qualify for a loan and what you will pay. In late 2025, Fannie Mae made a groundbreaking change, removing the hard minimum credit score requirement of 620 for loans processed through its automated desktop underwriter system. On the surface, this sounds like great news, allowing borrowers with thinner credit histories or lower scores to get their foot in the door. It opens up the possibility of homeownership for more people. However, this change comes with a very important catch. While the automated system no longer has a strict minimum to deny an application, lenders are still required to obtain and consider credit scores. More importantly, the Federal Housing Finance Agency overhauled the LLPA framework. The redesigned matrix recalibrates the fees based on updated risk assessments. The most critical change is that the threshold for the most favorable rates, the lowest fee tier, has moved up. What used to be the top tier at a 740 FICO score is now closer to 760, or even 780 in many scenarios. This effectively creates a two-tiered system. Rewards for exceptional scores have increased. You can no longer just aim for above 740 and assume you're getting the best deal. The goalposts have moved. For 2026 and beyond, the new target is a FICO score of at least 760, ideally 780 or higher. Reaching that top tier can eliminate the credit score-based LLPA, save you substantial money monthly and over the life of your loan. Knowledge of this change is your first line of defense against overpaying. When you are looking for a mortgage, not all loans are created equal, especially when it comes to credit scores and fees. The LLPA framework we have been discussing applies specifically to conventional loans, those that conform to Fannie Mae and Freddie Mac. These are the most common type of mortgage in the country. However, they are not your only option. Government-backed loans operate under a different set of rules. FHA loans, VA loans, USDA loans can be a fantastic alternative for certain buyers, particularly those with lower credit scores or smaller down payments. FHA loans are insured by the Federal Housing Administration. According to FHA.gov, they sometimes allow scores as low as 580 with a 3.5% down payment. Instead of LLPAs, FHA loans use the mortgage insurance premium, upfront and annual paid monthly. VA loans are a powerful benefit for eligible veterans, active duty service members, and surviving spouses, often no down payment and no monthly mortgage insurance. They typically have a one-time funding fee which can be financed into the loan. USDA serves eligible rural and some suburban areas with income limits and geographic restrictions. Visual. 3-column comparison. Conventional. FHA. VA. Credit score, down payment, insurance, fees. When a lender says they have pulled your credit, the process is a bit more complicated than just looking at a single number. To get a comprehensive view of your creditworthiness, lenders are typically required to obtain credit scores from all 3 major credit bureaus: Experian, Equifax, TransUnion. This is because your credit file can have slight variations between the bureaus, resulting in 3 different scores. You might have a 750 from Experian, a 765 from Equifax, and a 745 from TransUnion. So which score does the lender actually use to determine your interest rate and fees? The answer is the middle score. In the example above, the lender would discard the highest score, 765, discard the lowest score, 745, and use the middle score of 750 as your representative credit score for loan qualification and pricing. This is standard industry practice. This is why it is so important to know all 3 of your scores, not just one. You might be checking a free credit service that only shows you your TransUnion score, which happens to be your highest, giving you a false sense of security. The lender, however, will be making their decision based on that middle number. The situation gets even more interesting when you apply with a co-borrower, such as a spouse. They will identify the middle score for each of you. From there, the rule is simple and strict. The lender uses the lower of the 2 middle scores to determine the loan terms for both applicants. Let's talk about something that seems completely unrelated to mortgages at first glance: high-fee premium credit cards. Many people ask me, MG, why would I ever pay a $695 annual fee for a card like the Amex Platinum? It seems like a total waste of money. I understand that logic completely. Paying a high fee for a credit card feels counterintuitive when you are trying to save money. However, my point is this: that annual fee, while significant, can be absolutely tiny when you compare it to the potential savings on your mortgage. If having that card provides you with travel credits, lounge access, or business benefits that genuinely offset the cost, it might be a worthwhile tool for your lifestyle. But that is a separate conversation. The real issue arises when you sweat the $695 fee but remain unaware that your 735 credit score is costing you an extra $110 per month on your mortgage, $1,320 per year, and a staggering $39,600 over the life of the loan. In my opinion, the mortgage math almost always wins when you compare it to credit card points and perks. Your primary financial focus before a home purchase should be optimizing your credit score to land in the top pricing tier. We share elite money hacks every single Thursday on CardVantage. If you don't subscribe, you're losing thousands to the banks. Subscribe now so you don't lose your chance at the 800 Club lifestyle. Do not let the allure of club perks and sign-up bonuses distract you from the tens of thousands at stake in your mortgage rate. Theory is great, but action is what saves you money. I want to give you 3 clear, simple actions that you can take right now. First, check your middle FICO score. Don't rely on the free score in your credit card app. Go directly to myfico.com or a service that shows all 3 bureaus: Experian, Equifax, TransUnion. Lenders use your middle score. Identify that number, it's your baseline. If you find errors on your reports, dispute them immediately. Second, delay all new debts in the months before and during the mortgage process. Do not buy a new car. Do not open new credit cards for store discounts. Do not take out a personal loan. Any of these can trigger a hard inquiry. They can also change your debt-to-income ratio and drop your score before closing. I learned this the hard way. I took a small auto loan weeks before closing, and the final credit check caught it. My score dipped, my risk profile changed, and I had to scramble to avoid a rate increase. It was stressful and avoidable. Third, actively improve your score with simple, proven techniques. Focus on credit utilization. Pay balances below 30%, ideally below 10%. Don't close old accounts. Keeping them open protects your average age and total limit. Higher total limit lowers your utilization ratio. Make every payment on time, every time. Small, consistent actions can move your score 10, 20, or 30 points, enough to reach a better LLPA pricing tier. Let's put everything we have discussed into a simple, concrete example to show you exactly how much money is on the line. Imagine buyer A with a 735 score and buyer B with a 780. Same $400,000 home, 20% down, loan of $320,000. In the current 2026 LLPA environment, buyer A might see a 0.75% adjustment while buyer B gets 0. If the base rate is 6%, buyer A could be at 6.75, buyer B at 6%. That's about $2,075 versus $1,919, a difference of $156 every month. Over 30 years, that's $56,160 more in interest. The price of a car, a kitchen remodel, or a serious retirement boost, gone. To avoid this fate, I recommend you ask your lender to show you the LLPA matrix. Ask, if I raised my score by 20 points, would I be in a better pricing tier? A good loan officer will be transparent and help you strategize. This content is for educational purposes only. It is not financial advice. Make decisions based on your own situation and research. Sources: FHA.gov, Fannie Mae 2026 Guidelines, myfico.com.